If you're a first-time home buyer, there are a few things you absolutely need to understand before you start shopping for a home. In this video, we're focusing strictly on conventional mortgages. If you're interested in learning more about government-backed options like FHA, VA, or USDA, we have separate videos that break those down in detail. And if you want a step-by-step explanation of the full pre-approval and mortgage process, check out our video on that as well on our channel or website. One of the most common misconceptions is that there are tons of zero down or no closing cost options available to first-time buyers. In reality, most of those options come from grant programs or down payment assistance, and we're not covering those here because they vary dramatically by state, county, and city. The key thing to remember is this: nothing is free. Every assistance program has rules, restrictions, and trade-offs. That said, there are true zero down options through government loans like VA and USDA, but those are separate programs with their own eligibility requirements. With a conventional loan, first-time buyers can put down as little as 3%. You're considered a first-time buyer if you've never owned a home or you haven't owned a home in the last 3 years. This 3% down option only applies to single-unit properties such as single-family homes, condos, and townhomes. It does not apply to multi-unit properties. Here's something many first-time buyers don't realize. If your qualifying income is below the area median income or AMI for the location you're buying in, certain interest rate pricing adjustments are waived on conventional loans. Your interest rate is built from the base rate plus adjustments for things like credit score, down payment, loan term, and property type. When those adjustments are waived, you may be eligible for a lower interest rate, sometimes meaningfully lower. One important clarification is that this is based on the income used to qualify. For example, if your base salary is below the AMI and that base salary alone qualifies you, bonuses or variable income that push the total pay higher may not disqualify you from this benefit. There are also potential additional benefits if your income is below 80% of the AMI, depending on the program. You also need to understand discount points, often just called points. Points allow you to buy down your interest rate. 1 point equals 1% of the loan amount. You may pay more upfront in exchange for a lower rate. But here's the problem. Many lenders quote rates with points baked in without clearly explaining what it means or providing alternatives. Points are not inherently bad, but they're not always the right move, especially for first-time buyers. Most first-time buyers stay in their property on average for about 5 years. If the break-even period on points is longer than that, you may never see the benefit. Points also aren't always clean numbers like 1 or 2%. Pricing changes daily based on bond markets, which affects both rates and point costs. Here's the bottom line. Paying points is a choice, not a requirement. Always ask to see rates with points, rates without points, and the break-even timelines. In addition to your down payment, you'll also have closing costs. These vary by location, but typically include lender-related costs such as underwriting, credit reports, and appraisals. Possibly application fees, processing fees, origination, or discount points. Always ask upfront what lender fees are being charged. Third-party costs and government fees are things like title and escrow, recording fees, transfer taxes, and inspections. If you're buying a condo, the HOA or management company may also charge a fee for the required documentation. Next are prepaid items. These aren't really fees per se, they're items you'd pay for just owning a home, but important considerations. These are things like property taxes, homeowners insurance, and prepaid interest. When putting less than 20% down, you're usually required to escrow taxes and insurance, meaning that you're paying them as part of your monthly payment with your mortgage. The servicer then pays those bills for you going forward. At closing, the escrow account is pre-funded with a few months of taxes and insurance, and you'll also pay the first year of homeowners insurance premium. You don't make a partial mortgage payment at closing, just daily interest for the remainder of the month. This amount depends on how many days there are from closing to the next month. As a rough estimate, total closing costs are often around 3% of the purchase price, but that can vary. If a family member or relative is helping you with your down payment or closing costs, that's perfectly acceptable. The funds need to be documented, sourced, and accompanied by a signed gift letter. Borrowing from a retirement account is often allowed for first-time home purchases, sometimes with little or no penalty from your provider, but this is not a blanket recommendation. Always review the long-term impact before going that route and check your specific plan requirements. The single most important thing you can do as a first-time buyer is educate yourself early. There's a lot of information online, but separating fact from fiction and federal requirements from local ones isn't easy. Working with an experienced loan officer who understands the nuances can save you time, money, and stress. If you have any questions or want help exploring your options, don't hesitate to reach out. If you found this video helpful, please subscribe and follow us on social media for more practical mortgage educational content. Thanks for watching.